Lemonade stock is up 34% as I'm recording this today. The company reported earnings, and yes, their earnings were fantastic. Beat expectations strongly. Growth is accelerating. All of their underwriting results continue to look better, and they raised guidance. So basically, all of the things you want to see from a business, Lemonade delivered those things in the quarter. I'm Jason Hall. This is Investing Unscripted. I'm going to go through the company's earnings and talk about what's going great, what investors need to watch for, and whether or not I think Lemonade stock is still a buy after this crazy run in a single day, topping what's really been a great run for the stock during 2024. Before we get into the details, though, we get to make these videos because of our partnership with the Motley Fool. Motley Fool sponsors this video, and if you're looking for more great stock ideas, go to our link. Our special link is fool.com/unscripted. If you go to that link, you can get access to the Motley Fool's 10 best stocks to buy right now. They give you updated information every month. A membership is worth its price. Check it out. You'll be glad that you did. All right, so there you have it today. The stock is going on an absolute tear, and it's continued to move higher and higher throughout the day. So far this year, the stock has more than doubled now after today's great run. Over the past 12 months, the stock is a three-bagger. It's up 235%, so it's tripled. And then some. Here's the main thing that's driving the stock higher today. The third quarter results, so in-force premium, that's a big important number. It's not revenue, but this is a big number you want to look at. Accumulating that premium is really big. That was up 30%, 24% customer growth. Premium per customer continues to move higher too. One of the things we're seeing from Lemonade is that customers are signing up for more different kinds of insurance. Started out was big in pet and rental, still is big in pet and rental, but now with homeowners insurance, auto insurance, expanding into Europe, really growing quickly. Gross profit dollars continue to move higher as some key profitability metrics continue to improve. I don't love their adjusted free cash flow metric, but the business is starting to generate positive cash flow from operations. That's good. There's more to it as an insurer, but that's a step in the right direction. This really illustrates that the growth rates have continued to accelerate as the loss ratio has continued to come down. A couple things about the loss ratio coming down, and then we'll talk about the growth rate and how they've been able to accelerate that. The loss ratio has come down because they've gotten better at the underwriting. Their AI model that they use, in addition to some real humans that have joined the business, executives involved in underwriting, have gotten better. But the insurance industry broadly is going through a period where profitability is better and the underwriting results are better across the industry. So I think that this isn't just Lemonade getting better at it. The industry is going through a period where pricing is better. Insurers have been able to raise prices in a lot of cases. That's an industry trend that's helped Lemonade a lot. But they have also certainly gotten better at it in terms of the AI that they use to quote. They're just pricing the insurance better. At the same time, the growth rate, there's something really important that's driving Lemonade's growth, customer acquisition. That's one of the reasons that it still has a negative combined ratio. In other words, it's still on a full underwriting basis. It's still generating underwriting losses. Okay, so here we have the operating statement. This is really important because you see the different revenue lines. Net earned premium obviously is the most important one here. But the key is that you look at these revenue sources and then you look at expenses, loss adjustment expense and other insurance expenses. These are substantial, and every insurer is going to have these on a regular basis. One of the areas, though, where Lemonade continues to choose to spend aggressively is in sales and marketing, customer acquisition. Those costs you can see on a quarterly basis were up year over year. And then for the first 9 months of the year are substantially higher than they were in 2024. And that's with intent. The company is aggressively spending money to acquire customers. A lot of the customers that it's acquiring them earlier in their life's journey of insurance products. That's really important because you may pay a premium to acquire that customer now, but if you can establish a 10, 20, 30 plus year relationship, you pay that acquisition cost once, the marketing expense, you have that customer, and then you get to enjoy the majority of the bulk of the premiums for the rest of your relationship with that customer for years. They're taking a really smart strategic approach to that as they continue to expand into more markets, offering more insurance products. That's really kind of the key that they're doing. So I bring that up for a couple reasons. Number one, they've been able to accelerate growth because they have been aggressively expending to do that. They have what they call a synthetic agent model, and it's basically a financial arrangement, a partnership with other parties to help kind of soak up some of those upfront costs. The point is that it's helping them make sure that they can maintain a strong balance sheet while still aggressively spending for growth, even as they continue to gain benefits of scale and also just get better at underwriting to get closer and closer to profitability. So there are a lot of things that are going great for Lemonade right now. Still has a long way to go. I want to stress that at some point, the cost of acquisition for customers versus the amount of premium that they're earning, those numbers have got to balance out so they can get to a combined ratio where they're generating an underwriting profit. That's core to any insurance company for the long term to be able to do that. So I think they can get there. All right, let's talk about valuation. This goes all the way back to when Lemonade went public. This is price to book value. This is a useful metric for valuation for insurance companies. At 11 times, it's extremely, extremely expensive. Even like top-notch insurers like Progressive, one of the big auto insurers that has such an incredible business. This is like 2 to 3 times the multiple that you get for those companies. But those companies are also orders of magnitude larger than Lemonade. Lemonade just now passed $1 billion in force premium. Some of those companies have $20, $30 billion and more in force premium. So they're substantially larger and they're not growing at anywhere near the rate that Lemonade is. Now, I want to put market cap on here too, because that's useful. Again, just under $6 billion in market cap. Management thinks over the next decade or so, it can 10x the size of their business. And if you think of that 30% growth rate in in-force premium, obviously it's going to be tough to maintain that sort of growth rate. Valuation matters, but at the end of the day, for a business like Lemonade, you're buying it based on their execution, their ability to continue to take more and more share of the market. And as they get to scale, their efficiencies with AI and the benefits that they have that they say will drive out cost. And then as those marketing costs, those customer acquisition costs start to kind of smooth out a little bit on a per customer basis, then that's where investors should look to make money for a company like Lemonade. There's one more stat that I want to bring in. I'm definitely bullish on Lemonade, the business, because it does continue to make improvements from less than $6 billion market cap. I do think there's still a ton of upside over the next 5, 10 plus years for Lemonade. There is one caution sign that I want to throw out there, and that's short percentage. So again, the stock is going up like crazy today. And the reason it's going up is, sure, the results were good, but they weren't like change the world good. And they did raise guidance, but they raised guidance a little bit, not a ton. So this is the thing I think that is driving the stock up a ton today. Almost 22% of shares outstanding were sold short and 26% of float. Float is the shares that readily are available to trade on the market. So it excludes like a lot of shares held by insiders that wouldn't necessarily ever trade. Over 20% shares short is a ton. It is a lot. So today's big rocket is a short squeeze. That's temporary momentum. And it does open the door in weeks ahead, months ahead, even for maybe the stock to come down, right? So just be aware, this has been a super volatile stock since it went public. I think that's going to continue. I love the long-term potential. I think it's a great stock to build a position out in over time based on the results remaining good. I think this price can be a winning price over the long term, but I also think there's a really good chance that we do see the stock come down in the near term. Investors, you need to be prepared for that, whether it's to add to your position or if you buy at this price, just to hold through the ups and downs of the market for the long term, but just keep focusing on what matters the most. And that's the business itself continuing to deliver great results and move closer and closer to generating a good combined ratio of total underwriting profitability as it continues to acquire more customers over time.